Chapter 11, Planning for Retirement Needs. True, false. The amount that a client has invested in real estate is not included in an assessment of retirement income need. That is false. His real estate investments would be included in retirement needs because it's possible that the real estate could be liquidated and therefore would be included as an asset to be able to utilize for retirement. Number 2, retirement planning must consider current or future alimony and child support payments. That is true. All income and expenses are necessary to be planned for retirement. Number 3, when helping a client plan for retirement, it is far more important to use an estimation process that is accurate as opposed to one that the client understands. And that is false. Although accuracy is important, the client must understand the retirement plan. Therefore, using one that the client understands is most important. Number 4, benefit plans, including health insurance, life insurance, and fringe benefits such as membership in company athletic or health clubs after retirement, should be considered in the retirement planning process. That is true. If these are expenses that the client is going to incur, whether they were part of a fringe benefit or not, they should be included in the retirement process. Question 5. Estimating what it costs now for a standard of living that the client considers acceptable and adjusting those amounts for inflation does not provide a reasonable estimate of total capital needs. And this answer is false. Inflation will adjust what it costs now for a standard of living that the client considers acceptable. So inflation needs to be taken into consideration, and that is a good thing. Number 6, most people relate to monthly cash flow rather than weekly or annual cash flow, and that is true. Multiple choice question 1. Which of the following are considered a fundamental steps in the retirement planning process? 1, assisting client retirement financial needs. That makes sense. 2, determining how much of the need will be met. That is true. 3, establishing a plan for any cash flow shortfall. Well, that is true. 4, selling investments based on projected income needs. That is false. Selling investments based on projected income needs is not an appropriate item for considering fundamental steps in the retirement planning process. So the correct answer is C, 1, 2, and 3 only. Question 2. Which of the following non-retirement related needs may have a significant impact on retirement assets? A, long-term care of a parent. Well, yes, that's very true because one doesn't know that. Client's primary housing, well, it's true, it's important, but they already have housing. Social Security income benefits, well, while that's important, it doesn't have as significant an impact as the long-term care. And then D, private Medicare supplement insurance. That may need to be paid, but I would not call that a significant impact. So the answer is A, long-term care for a parent. Question 3. Capital needs at death can have a significant impact in any planning scenario. Which of the following is a reason to include this area when doing retirement planning? A, clients cannot purchase insurance at more advanced ages. Well, cannot is a very strong statement. It may be expensive, but it can be purchased. B, funding these needs is more economical when a client begins at a younger age. That is very true. C, these concerns are unlikely ever to become a capital needs at death issue. Well, that's not true. Ever. Anything can happen. D, the purchase of insurance eliminates the need for any further capital needs at death planning. Insurance may help, but there always are situations requiring capital needs at death planning. So the best answer is B, funding these needs is more economical when a client begins at a younger age. Number 4, looking beyond pure capital accumulation needs, which of the following is a primary capital needs planning objective? So we're talking about capital and needs planning objective. A, determining pension plan income benefits. Well, that's dealing with income. Identifying retirement cash flow. Those are cash flow issues. Accounting for income from future savings. We're talking about income. Translating capital into living expense needs. And there is capital. So the answer is D. Question 5. Which of the following would not be included in a retirement fact finder? Balance in profit sharing plan. I think that's important. Expected Social Security income. For a number of individuals, that is the most important part of their retirement planning. C, amounts invested in mutual funds. Well, absolutely. The amount of last year's tax refund, well, that was last year. I don't think that's going to affect their retirement. And E, client goals and objectives in retirement. Well, of course, that is necessary. Therefore, the best answer is D. The amount of last year's tax refund might not be included in the retirement fact finder. Question 6, which of the following is not an acceptable method for overcoming a retirement shortfall? A, cut back on expenses before retirement. That's a good one. That works. B, invest a large portion of your retirement portfolio in a high-risk investment to obtain a higher return. No, we cannot increase their risk, and therefore we will not invest a large portion in a high-risk investment. So that would not be appropriate. Increase pre-retirement savings. That's good. Retire later. That's good. Tap into home equity. That's good. The answer, what's not acceptable, is B. Question 9. Which of the following is the last step when using the 7-step planner to determine the required current monthly savings that will meet a future retirement income objective? A, calculate retirement cash flow. Well, that's down towards the bottom, but that's important. Identify income from current assets. That's towards the top. Calculate the required savings to fund the shortfall. Well, that sounds like it's important. Adjust income sources for inflation. We need to do that, but that's early. And identify fixed income and amounts payable at retirement. Of course, we need to do that. The last step would be C, to calculate the required savings that would fund the shortfall. Question 7. Which of the following pieces of information about a client's employee benefits is needed? A, ERISA documents. Well, those may be legal documents for ERISA to understand ERISA, but not as far as the employee benefit plan. B, amount the client pays monthly. While it's interesting information, it's not needed. The summary plan description, I believe this is needed because we don't know exactly how the plan works unless we have that summary plan description. D, client's description of the benefits. Well, that's good, but maybe they don't clearly understand them, even though they think they do. And E, current value of the benefit of the client retired today. While of interest, will not affect exactly the benefit upon their retirement. So the most reasonable answer is C, summary plan description. Question 8, our client, 5 years from retirement, the most accurate method for her to use in calculating her income needs during retirement is the expense ratio. The detailed expense ratio is always the most accurate method. Question 9, our client, are 65, will retire later this year. Their planner evaluated their situation and found that they are going to be approximately $100 per month short of what they need to sustain their desired lifestyle. The client should consider A, adjusting their expenses downward before and during retirement and saving more. B, placing the bulk of their retirement assets into one or two risky assets with good potential for a high yield. I don't think I like that. C, continuing to work and contribute to a retirement plan for a few more years. Choice D is A and B, E, A and C. Well, the answer is A and C, so it's E. Two risky investments with good potential for high yield is not an appropriate action for the planner. Question 10. William Best is completing a retirement plan for a client. Which of the following sources of his client's income would William ignore when estimating client's income sources? A, current and future asset income. No, we need that for the retirement plan. Pension income from a former employer. Well, that's income. We want that. Rent from a duplex owned by the client. Well, that's good because that's going to be income. Income tax refunds. Well, they can help, but they're small. So that probably would not be a source to include. And E, Social Security, absolutely. So the right answer is E, income tax returns. Question 11. Tom Closton is the owner of a closely held business. Tom's financial planner told Tom that developing a retirement plan for him will be much simpler than developing a retirement plan for a non-business owner who do not have the bulk of their assets tied up in one place. The statement of Tom's financial planner is, and this is true or false, the answer is false, because a closely held business owner is very complex. Their cash flow and their assets are complex, and consequently, it is more difficult to do a retirement plan for a closely held business owner.